Good afternoon, everyone. Today is Friday, the 28th of September, 2012, and this is Brian Shannon from AlphaTrends.net. The market did finish with some losses here this week. The SPY down 1.3%, Nasdaq 2.25%, semis down 2%, and they actually finished the month down 4%. September was a positive month generally for equities. Oil sold off, as did the commercial real estate index. Gold had a good month, but generally for equity investors, it was a positive month, but we saw a lot of volatility, and obviously with the weakness of the last 2 weeks, that gives us an idea of what that volatility was. Let's take a look at the market here. We're taking a look at the S&P 500, the SPY, the ETF that measures the S&P 500. That is, for those that aren't familiar, we did kind of get to this trend line here, and what I had spoken about earlier in the week and mentioned on Twitter was that the 61.8% retracement level of the September low to the September high, which is basically since this little rally began. It's just a coincidence that it does represent the low and the high of the month. But that range, basically, that the distance we traveled higher, we traced it down almost exactly to 61.8%. I was talking about how we don't necessarily want to buy at that precise level. Similar to a moving average, they are good. That is, Fibonacci levels are good at identifying a potential turn in the momentum. This week, obviously, it did turn pretty much right on that number, but we are still below the declining 5-day moving average in the S&P 500, and that gives us reason for continued caution going forward. And we started out the week with a general caution because the shorter term was breaking down, but within a more bullish environment here, because obviously the daily and the weekly time frame are higher. What we don't want to do is buy on the pullbacks, because we never know where the pullback is going to find support. Now, had you bought at 61.8%, it would have worked well in the S&P 500 for at least a trade, but the market fell short of the declining 5-day moving average 2 days in a row now, and perhaps we're starting to see a little bit of signs of stabilization. I think that next week we want to see the S&P 500 get back up at least above this 145 level, and back above 145 you can see that was prior support, which was resistance this week. So we have the possibility that we're shifting back towards a turn higher, but with the declining 5-day moving average, we still have to be a little bit cautious here. And I say we have the possibility because this could begin to show us our first higher low, and then if we break the 145, the intermediate term will have turned positive with a series of higher highs and higher lows. So we still kind of the same outlook as last week, which was we're in a bullish environment overall on the daily time frame, but we're experiencing a pullback. Now we're starting to show a little bit of signs of stability, so we'll look for evidence from the market that tells us that it is in fact turning higher. The Nasdaq doesn't have that evidence. You can see here we're looking at a 30-minute time frame, and we broke some important support at 69.50 this week, and the market sold off sharply down to just under 68, and it bounced just short of that 69.50. So this prior support area acting as resistance also along that declining 5-day moving average. When we take a look at the 10-minute time frame, this is our prior band of support. We broke down, rallied back up, fell just short of the 5-day moving average, and that's where the real waterfall came in. We rallied up to the declining 5-day moving average, and back below 68.50, then perhaps we test these lows, and we've still got the possibility of coming down to the 50-day moving average, which is now at about 68.5, and that's also this prior support level. So short to intermediate term, we're still kind of cautious here. Today's advanced decline line, we did have 1,800 decliners and 1,175 advancers, so a generally negative day, which obviously is represented in the numbers as well. The Russell 2000, we broke this uptrend line here this week, and it stayed below it. We came down to an important level of what was prior supported about that 83.5 area. So we look at this now, and let's take a look actually at the 30-minute time frame. You can see that this was the bigger level. We were hoping this would act as support, but saying that if it broke support this week, that we would at least test this area. Obviously, we broke down a little bit further than that. We are below a declining 5-day moving average, and we have these lower highs. So we're going to have to get, I think, for the Russell 2000 to really trust it again, we're going to have to get back up above 84.5 next week. Now, the daily time frame does still look good, and we can't forget, well, I can't forget to mention what the heck is just going on with my scaling here. My mouse is all messed up, and it doesn't seem to want to work for me. Here we go. I was going to say we can't forget about this inverted head and shoulders pattern, and this is why when we observe these head and shoulders patterns and other patterns like this, we have an idea of what the measured objective would be. 73 up to 82 would be 9 points added to 81, which gave us a price objective of 90, and we might still go on to meet that price objective of 90, but when the market starts falling, breaking important support levels like it did this week, and showing a pattern as it has here of lower highs and lower lows below a declining 5-day moving average, it simply doesn't make sense to continue to hold those positions unless you're maybe Warren Buffett, who trades 100 million shares at a time and can't get out of them. And I shouldn't say Warren Buffett trades, although there was a pretty interesting article about that recently. I forgot what stock it was, but he did trade it in about a 6-month period. It might have been even Intel. Anyways, back to the subject at hand, the Russell 2000. We need to see this market stabilize and get back above 84.5 to trust it. The weakness, obviously, the real weakness for the month was in the semiconductors. They were down 4%. We've been talking about this semiconductor weakness, and we've got, they're only up 4% year to date. So I think that, we've been emphasizing this support level at 32. We broke that hard this week, came down to the 2/3 retracement of the summer lows up to the recent highs, and we dipped down below there, but closed right on that level. And we've still got this 32 looming as a bigger level, and let's just clear those lines off of there. But this 32, 32.25, this prior support in here is likely going to be a bigger obstacle for the semiconductors to get back up above. If they can do that, then they turn a little bit more neutral, but right now this semiconductor index is really kind of a mess here, so I wouldn't suggest trading for the long side here, definitely, unless you're just scalping in there. But 32.25 is a likely level where sellers are going to be found. The financials, what were they down on a percentage basis? That's not what I was looking for. The semiconductors were down. The financials rather had lost 1.5% this week, and just a controlled, steady pullback. And a lot of people say they want to buy a pullback. You don't want to buy pullbacks. And what I mean by that is, you look at this and say, we were looking at it as saying, well, 1580 should be support, but if 1580 fails, then what's the next level it goes down to? And a lot of people will stick their bids in at 1580, thinking that is support because it was a prior important level in the past. But now, the market continues to show a pattern of lower highs and lower lows in here. I'm just going to add a few days to this so that we can get a better feel for that 5-day moving average. So we have the pattern of lower highs and lower lows below a declining 5-day moving average, and when the 5-day moving average is declining, then we generally don't want to trust the long side. So here's our resistance band, 1575 to 1580. If we can get back above that and hold above that next week, that would be a good thing, I think, for the bullish case here, as the market has pulled back a little bit deeper than I would have hoped, but perhaps it gets down to the 50-day moving average also, which is just at an important level here of 1520. So don't rule out that we could still continue to pull back a little bit deeper down towards the 50-day moving averages. And the in the SPY S&P 500, that would be down at about 141.53. So I wanted to talk about let's take a look at Google. I've been saying it for several last couple months, since about here, that I thought the stock would hit 800 by the end of the year. I still think that's on target for it, although the stock has gotten arguably a little bit ahead of itself, extended here. I don't think it makes for good low-risk entry points at this area, but it is in a solid uptrend, and Apple saw some profit taking, broke what I think is a pretty important near-term level at about $680 a share. That was prior resistance. It didn't hold as support, but it did hold as resistance again. So keep an eye on Apple next week. If it gets down below 655 or so, then I think that you're going to have to be concerned a little bit about the Nasdaq. You might say it's tracing out this inverted head and shoulder, or this head and shoulders pattern, but when you have such a strong uptrend, I don't put a lot of emphasis on those patterns, but it's just something to be aware of. So 655, keep an eye on that next week. I also wanted to follow up on Yelp. I had posted a video Thursday morning, and it was over at Traders Press, and I tweeted that about how Yelp looks like it's maybe on the verge of breaking out. I was talking about 2650 as a level for it to break. I am in some of this, not a big position. I don't have a lot of confidence in longs when the market trend is weak as it is, and we have a negative advanced decline line. But Yelp looks like it's going to be able to continue to move higher. In that article or video, I think I mentioned a stop way down here. I would say a worst case stop at this point should be just below 26 bucks a share. But my point I was going to talk about is buying pullbacks, and a lot of people are trained you buy pullbacks, and there's nothing wrong with looking at pullbacks, but you don't want to buy it as it's pulling back. So, for instance, a lot of people will look at American Express and say, "Hey, I want to buy it right here at that 10-day moving average." You definitely want to look for support at that 10 or that 20 or that 50-day moving average, but then you want to look to those moving averages on the daily time frame and say, "Here's a potential area where this market could find some support." So instead, what we do then is we look at American Express on a shorter term time frame, and during those times when it was down here at this level of $58.40, $58.40 right here, this is where it had already broken a lower low on the 10-minute time frame, and it was below the 5-day moving average. So we had a series of lower highs and lower lows, and we still do up to right here. But we don't have that on this time frame, but we do have a declining 5-day moving average. I like to wait for that 5-day moving average to flatten out. By the way, as you probably are aware, Realtick is the sponsor of this show each Friday. Realtick.com is the trading platform that I use for these videos and for trading as well. So take a look at them at Realtick.com. Let's take a look at a couple other examples of why not to buy pullbacks. Fire was one that it looked like it had broken some resistance over here, pulled back on lighter volume to a rising 10-day moving average, and it got a little bounce over here, and that looks like it was probably a good purchase, right in this area. But as we look at it, we had a declining 5-day moving average. So when we have a declining 5-day moving average, they are generally very difficult to trust. We want to see the 5-day moving average flatten out, just like in LNG. LNG is pulling back right now, and it's got a great story. It had a nice run in here. It pulled back to the 10-day, then the 20-day, but it continues to just pull back and show a pattern of lower highs and lower lows on this shorter term time frame. So what we're looking for is more neutralization. Perhaps we spend a couple days down in this area under 16, and then it breaks a higher high. Well, then we would have an uptrend on this shorter term time frame, which would put it in alignment with the uptrend on the daily and the weekly time frame. So that's what we're looking for in terms of trend alignment. You could keep an eye on a stock like MDR, which had broken some resistance and looked like, hey, it's that resistance should become support. It's a low volume pullback relative to the advance, right to the rising 10-day moving average here at $12.45. But at $12.45, the stock was below a declining 5-day moving average and showing a pattern of lower highs and lower lows. So this would tell you to stay away from that until we get, I would say, probably 12.50 next week would be a good level to keep an eye on this. And one of the names that has beat up a lot of people in here recently, I think, is 3D, and then you have Stratasys. These are great story stocks. But they're volatile stocks as well. They can and do get hit hard, just like any other stock. Doesn't matter, if the 3D printing or whatever the great story of the day is. Even when we get these moves above the 5-day moving average, and that 5-day moving average is still declining, I consider the short to intermediate term trend guilty till proven innocent, and most of those rally attempts will in fact fail. And in the subscriber chat room, someone was asking me earlier this week about buying Triple D up here. I said, I think that if you're looking for a buy, you want to see it stabilize, and it should at least pull back to the 5-day moving average. But instead, it continued to pull back, make lower highs and lower lows, and now the stock is in a confirmed downtrend still on the intermediate term time frame. There's no sign still of stability. Perhaps next week 34 will be an important level for it, but it's gotten pretty beat up, and I think the chances of a strong bounce counts are fairly low here. So hope that was useful and you learned something. Be sure to check out alphatrends.net for a special offer on the site, and have a good weekend. Thank you.